Every year, Americans spend over $150 billion on life insurance, and a massive chunk of that money is quietly disappearing, not into protection for your family, but into fees, commissions, and investment returns that almost nobody actually needs. What if the policy sitting in your drawer right now is costing you thousands of dollars more than it should? Here's what you need to understand first. There are two main types of life insurance that most people encounter: term life and whole life. And the insurance industry has spent decades making sure you buy the more expensive one. Term life insurance is exactly what it sounds like. You pay a premium. You're covered for a specific period: 10 years, 20 years, 30 years. If you die during that term, your family receives the death benefit. If the term ends and you're still alive, the policy expires. Clean, simple, and extraordinarily affordable. Whole life insurance, sometimes called permanent life insurance, promises coverage for your entire life, plus a savings component called cash value that grows over time. It sounds incredible. Lifetime coverage plus a built-in savings account? Sign me up, right? But here's where it gets complicated. A typical whole life policy for a healthy 35-year-old man with a $500,000 death benefit costs around $450 per month. That same coverage as a 20-year term policy? $30 per month. We're talking about a price difference of 15 times more for whole life insurance. So why do so many people still choose it? The answer lies in how insurance is sold and who benefits most from the sale. The primary argument insurance agents use to sell whole life is the cash value component. They'll say, "It's not just insurance, it's an investment. Your money grows tax-deferred and you can borrow against it anytime." Sounds amazing, but let's look at how the cash value actually works in practice. In the first few years of a whole life policy, almost all of your premium goes toward fees and commissions, not your cash value account. We're talking about agent commissions that can be as high as 50 to 100% of your first year's premium. After those early years, your cash value does begin to grow, but at a guaranteed rate of around 2 to 3% annually. The stock market has historically returned an average of 10% per year over the long term. So the investment inside your whole life policy is earning less than a third of what a simple index fund would earn you. But wait, it gets worse. If you die, your beneficiaries receive only the death benefit. The insurance company keeps all the cash value you spent decades building up. You read that right. The money you've been accumulating in your policy, tens of thousands of dollars, simply disappears back into the insurer's pocket when you pass away. You don't get both. You never did. So what happens if you take that 15 times premium difference and actually invest it yourself? Let's run the numbers. Imagine you're 35 years old. You buy a 20-year term life policy for $500,000. Your monthly premium, $30. You take the $420 difference between what you would have paid for whole life, and you invest it in a basic index fund tracking the S&P 500. At a historical return rate of just 7%, being conservative, over 20 years, that invested difference grows to approximately $220,000. $220,000 sitting in an account that is entirely yours, not the insurance company's, yours. By the time your term policy expires, if you've been consistent with your investing, you may have enough wealth accumulated that you no longer even need life insurance at all. This is exactly what the famous financial educator Dave Ramsey and countless fee-only financial advisors have been saying for decades. Buy term and invest the rest. Make no mistake, There are real situations where permanent life insurance makes sense. If you have an extremely high net worth, estate planning needs, or a special needs dependent who will require care long after you're gone, whole life might have a role. But for the average American family, it's almost certainly not what you need. If whole life is such a bad deal for consumers, why does it still dominate so much of the market? The answer is powerful: incentives. Insurance agents who sell whole life products typically earn commissions that are 5 to 10 times higher than those for term life. A single whole life sale can generate thousands of dollars in upfront commission. With economics like that, it becomes very difficult for an agent with a family to feed to steer you toward the cheaper option, even if it's clearly better for you. The industry also benefits from a phenomenon called confusion marketing. The more complicated a financial product sounds, the harder it is for consumers to comparison shop. When an insurance agent walks you through projections, illustrations, dividends, non-forfeiture options, and cash surrender values, it's exhausting. Most people just nod and sign. Here's your defense. Always ask your insurance agent directly. Are you a fiduciary? A fiduciary is legally required to act in your best interest. Most insurance agents are not fiduciaries. They are sales representatives who may recommend what pays them most. A fee-only financial planner who is also a fiduciary will give you advice that's tied to your actual needs, not their commission check. Now that you understand what to avoid, let's talk about how to actually protect your family the right way. Financial experts generally recommend carrying life insurance equal to 10 to 12 times your annual income. So if you earn $60,000 a year, you want $600,000 to $700,000 in coverage. This ensures your family can replace your income for a decade or more, giving them time to adjust financially. For most families, a 20 or 30-year term policy is ideal. If you have young children, go longer. If you're debt-free and financially independent, you may need less. The sweet spot: buy coverage that expires around the time your children are adults and your mortgage is paid off. 2 final tips. First, always compare quotes from at least 3 different carriers. Prices vary dramatically between companies for the same coverage. Second, buy life insurance when you're young and healthy. Rates only go up with age and medical conditions. A healthy 25-year-old can lock in decades of low-cost coverage that will protect their family for the rest of their most financially vulnerable years. Life insurance is one of the most important financial decisions you'll make, but it shouldn't be the most complicated. Term life is simple, affordable, and for the vast majority of families, it's all you need. The most expensive policy is not always the best policy. Sometimes, the smartest move is the simplest one. If this video helped you see your insurance differently, subscribe to Insure Smart. We break down complex insurance topics every week so you can make decisions with confidence, not confusion. Drop a comment below telling us what insurance topic you want us to cover next.